the simple moving average. Every platform shows it, every course teaches it, and almost every beginner uses it the same way. Today, we go deeper. Not just what the SMA is, but how professionals actually read it, what the different periods mean, and where it consistently fails. A quick foundation. The SMA adds the closing prices of the last N candles and divides by N. The result is a smooth line on your chart that shows the average direction of price. Above the line, buyers have been stronger. Below it, sellers. Every price in the window counts equally, and that detail matters more than you think. Not all SMAs are created equal. The 9 and 20 period track short-term momentum. The 20 is especially important because Bollinger Bands are built around it. The 50 period covers roughly 1/4 of trading days. Institutions reference it constantly. When the S&P 500 breaks its 50-day SMA, fund managers take notice. Then there is the 200. 1 full year of trading data. This is the most watched moving average in all of finance. When price is above the 200, the long-term trend is considered bullish. Below it, bearish. Headlines are written when markets cross this line. But here is what most people miss. A 200 SMA on a 1-hour chart only covers about 25 trading days. The meaning of any period depends entirely on the time frame you are looking at. Experienced traders do not look at one SMA in isolation. They look at how multiple SMAs are stacked. In a strong uptrend, you will see price above the 9 above the 20 above the 50, and the 50 above the 200, all of them sloping upward. This is called a bullish stack, and it is the highest confidence configuration for long trades. When the stack breaks, when the faster SMAs start crossing below the slower ones, the trend is deteriorating. And when the lines compress and tangle together, the market is in a range, no trend. That is your signal to step aside. The order of the stack tells you the trend. The golden cross. The 50 SMA crossing above the 200. It sounds powerful, and it gets a lot of attention. But here is the truth. Backtests on the S&P 500 show that by the time the golden cross fires, price has typically already rallied 15 to 20% off the bottom. During the 2020 crash, the market bottomed in March. The golden cross did not trigger until July. Most of the recovery was already done. The death cross is even less reliable. In March 2020, the death cross fired on March 30, literally days after the actual bottom. These signals confirm what already happened. They do not predict what comes next. Use them to confirm your bias, never as a standalone trigger. This is the SMA's fundamental weakness. It is built from past prices, so it always lags behind the current move. In a strong trend, that lag is tolerable because the direction is clear. But in a sideways market, the lag is fatal. Price whips above and below a flat SMA, generating signal after signal, and every one of them fails. This is called Whipsaw, and it is the #1 way SMA-based strategies lose. When the SMA is flat, it is telling you nothing. Ignore it. You have probably seen the EMA on your platform, sitting right next to the SMA. The difference is not just the formula. On a chart, the EMA hugs price more tightly because it weights recent candles more heavily. It reacts faster to new moves and does not suffer from the drop-off effect, where an old large candle exiting the window causes the SMA to jump even though nothing happened today. For longer time frames and macro trend analysis, the SMA is standard. The 200-day SMA is more widely followed than the 200 EMA. For intraday and short-term swing trades, the EMA is often better because speed matters. Neither is objectively superior. They answer slightly different questions. There is another way to use the SMA that most beginners never consider: mean reversion. When price stretches far above the SMA, it tends to pull back toward it. When it drops far below, it tends to bounce back. The 20 SMA is the most common anchor for this. But here is the critical rule. Only trade mean reversion in the direction of the larger trend. If the 200 SMA is sloping up, only look for long entries on pullbacks to the 20 or 50. Never short the overextension in a bull market. The market can stay extended longer than you expect. Let's practice. SPY, daily chart with the 50 and 200 SMA. Price is at 430, the 50 is at 425, the 200 is at 415. Both slope upward. The stack is bullish. Price pulls back from 440 to 420, breaking below the 50. First warning sign, but the 200 is way below at 447, still climbing. This is a pullback within an uptrend, not a reversal. The 200 SMA acts as a floor. The 200 SMA acts as a floor. Price bounces right off the 200 SMA at 488 and rallies back to 445. The 50 SMA, which had briefly flattened, resumes its upward slope. The bullish stack is restored. This bounce off the 200 in a bull market is one of the highest probability setups that SMA analysis offers. Not because the SMA predicted it, but because thousands of traders and algorithms are watching that same level. Weeks later, SPY pushes to 465. The gap between price and the 50 SMA widens to 25 points. Price is extended. Then it stalls, oscillating between 455 and 465. The 50 SMA flattens as it catches up. When the 50 goes flat, trend momentum is fading. This is not the time to open new positions. This is the time to tighten stops and watch whether price breaks higher or rolls over toward the 200. Remember, the SMA is a map, not a GPS. It shows you where the trend has been, not where it is going. The period you choose, the number of SMAs you stack, and the market regime you are in all change what the line is telling you. Read the slope, read the stack, respect the lag, and never rely on a single line to make your decisions. That is how professionals use the simple moving average.